Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Hello, everybody. It's Carter Froelich, and welcome to the Land to Lots podcast. In today's podcast, we're going to be discussing accessing capital for residential developments, and we'll be discussing debt, equity, lot banking, among other financing mechanisms. Today, I'm fortunate to have two of the industry's leading experts to unpack this topic, Mike Zarola, the Managing Director of Land Advisors Capital, and Chris Chioda, the CEO and President of Lakebridge Capital. Welcome, gentlemen. It's great to have you both on the show.
Thanks, Carter.
Thank you, Carter. Likewise.
Hey, I gave a brief background of each of you, but to give our listeners a little better understanding of who you are, what your companies do, and the markets you serve, if maybe each of you could take a little bit of time to introduce yourselves and your company. Mike, do you want to go first?
Yeah, thank you, Carter. Will do. I am Mike Zarola with Land Advisors Capital, Managing Director. Our firm is pretty much nationwide, with the exception, of course, California, where Chris is and his team plays. And really what we do, we focus on residential opportunities in the capital side of the business, whether that's debt, equity, lot banking, you name it, focus on that side of the business and providing advisory services to either developers, builders, and or capital groups, and connecting the dots effectively for folks.
Chris, how about you?
Sure. Chris Chioda, President of Lakebridge Capital. We're an advisory and asset management firm based in Orange County in California. We've got a team of 8 people, and we focus on helping our clients source, underwrite, and capitalize their projects. We play a very similar role to Mike. And like Mike, I think both of us have a private equity background. We've been on both sides of the table here.
Oh, great. So I think between the two of you, we are covering the entire market of the United States. Is that a correct statement? We got everybody covered. You know, one question I'd like each of you to answer, if you don't mind, is what is your assessment of the current development and home building market, given all the changes we've had in terms of interest rate, labor costs, housing demand, and your ability to locate and place capital for your clients? So I'm going to switch over to Chris. Do you want to go first and talk a little bit about what you're seeing primarily in California?
Sure. Well, since the Great Recession, it's been a very challenging market with labor and lack of supply of land out in California. The last 2 or 3 years have been pretty good. Interest rates dropped to unprecedented levels. And I really think that pushed a number of traditional equity players to the sidelines. It's interesting, this correction that we've been going through has actually brought a number of groups that had been on the sidelines back into the marketplace. A lot of those challenges still exist. There still is a lot of unaffordability. The supply chain and just labor is still very tight. But overall, the home buyer is generally still very strong due to high employment. So overall, we are still seeing capital available for pretty much every type of project we cover.
Okay, great. Mike, how about you?
Yeah, I think just to tack on to what Chris said, I think we did experience very similar dynamics, not outside of California, of course, in the other markets. I still believe, just as Chris intimated towards the end of what he just outlined, that I feel we're in a good spot. We are able to access unique forms of capital as interest rates have increased over the last year. That has created different lines of business, different strategies. And candidly, what we've seen over the last year is that our services are more in vogue and candidly just more desirable by folks, because some of those, I'll call it standard lines of capitalization, have been impacted or fractured even in some cases. So we've been beneficiaries of that in many regards. And our ability to be nimble and kind of, again, like I said, connect the dots for folks has proven to be, I think, pretty valuable in light of what's going on in the market today.
Yeah, that's interesting. And Mike, let me follow up with a question. You said unique forms of financing or something to that effect. Could you expand on that a little bit more? What are some of these unique financing mechanisms or opportunities you're seeing and utilizing in the market?
Yeah, I think, Carter, it's what we're seeing is given now that we're looking at prime rate of where it's sitting now at 8.25%, and folks that went the conventional route of financing would get an advance rate that was typically pretty attractive and would have a really great impact on a leverage return. What we're seeing is that with the rate increase, combine that with lower advances from conventional lenders, we're seeing that the private debt funds and or I'll call it those kind of groups are the spread between the cost of conventional debt and now private debt has narrowed pretty substantially. And because of that, and because the ease of private debt compared to an FDIC related conventional bank source, we're starting to see that just expand in a major way. So even before that happened, Carter, we had maintain a number of relationships with those types of groups, but it seems like they are busier than they've ever been in light of many, I'll call it traditional banks either being closed and or for all intents and purposes effectively closed because they don't have terms and advance rates that are able to really kind of move the capital stack in the way that we need it to be moved in order to build these projects.
Yeah, and are a lot of these traditional sources, and Chris, feel free to chime in here, are they still closed for all practical purposes, or are you seeing them start to open up, or they're just not available like they used to be?
Touching on the regional banking crisis a little bit, 2021 and 2022 and 2020 even were very big years for many of the regional banks, and they grew their loan portfolios to unprecedented levels. There was also a number of mergers and acquisitions that occurred over the past 2 or 3 years to expand a depository bases. So from what we're seeing, there are some very big players in that space that are on the sidelines, but there are also a couple groups that are still very active. And when they're getting active, they're getting more picky on sponsors, guaranteed loans versus non-guaranteed loans, and the profitability of projects. So I don't know if that answered your question. That was more of a debt side question. On the equity side, there was a lot of exposure to the build for rent markets, and those industries are still somewhat active. I think on the for sale side in California, the most active money right now is a lot of the traditional players focusing on long dated master plans. I think they see it as a really good time to potentially buy some bigger assets when there's more uncertainty in the market and there's some willing sellers. You might not get a lower price, but you can get better terms. And so that's one area where we're seeing a lot of traditional groups still very active on the equity side.
Yeah, no, that's real interesting. And as it relates to that, and we'll talk both about debt and equity, but how are the markets assessing land development and home building projects? And what are the key metrics and criteria that they're really focused on prior to providing capital to the project? And maybe we break this down between outside of California and California, because I think we're really talking about two different worlds to some degree. And moving forward, we'll just talk about the for sale market as opposed to the BTR, because that's a subject in and of itself. But Mike, do you want to take the first shot at that question as it relates to outside of California?
Yeah. And I think there'll be some similarities, Carter, but it is a good point. I think that a lot of groups that, while they are active and we're seeing a lot of activity, I think that the one thing that has changed from a year or so ago is the fact that a lot of folks are not willing and ready and able to respond so quickly. They want to see a project further along before they advance dollars to it, whether it's debt, equity, whatever it might be. In 2021 and even early 22, I think everyone was vying for their spot, musical chairs, just trying to fill up chairs. And, since things have leveled off and corrected, for lack of a better term, we've seen, obviously, rates have gone up in line with prime rate, but we've also seen equity groups, capital groups in general, want to see a deal that's further along and even shovel ready before they're advancing their dollars. They're not going to take entitlement risk or even, extended cost risk with closing on something that still needs final engineering. So that is one of the things that we're looking at and seeing more in the market, that you gotta push it further along through the process and get it to a point where they feel comfortable moving forward. So there's a little bit more certainty moving forward in light of where we are today. I think they're still focused on checking a lot of the boxes, which, means, the dynamics of that sub-market, the dynamics of that operator. I think everyone is tightened up on, the operators that they would work with and provide capital to. So the capital's out there. I think it's just being a lot more discerning and making sure that more I's are dotted, more T's are crossed than they were, a year or so ago.
Yeah. Chris, how about you? What are you seeing in California?
Well, Mike, I think that's a perfect point. California, the pre-development work, final engineering, is as risky as it's ever been. There's a lot of time that goes into that with the jurisdictions. And to your point, when you're getting a 9 to 12% loan, carrying a year to get permit ready just becomes financially unfeasible. We are, however, seeing a lot of activity on the entitlement front in California, and that's I don't know if everybody across the country knows about the very pro-housing laws that have been passed in California, but between SB 330, SB 1818, and the ADU ordinance, there are some very powerful laws that let you increase density on projects, implement much more favorable development standards. With the ADU ordinance, literally add another unit to a lot. There's a lot more protections on zoning and the ability of cities to prevent your project from moving forward. And that's really pushed capital into that area of investing in California. So I think that's one of the most popular investment strategies and really one of the most profitable ones in the market right now.
Yeah. Thanks for that. And for both of you, are the capital providers wanting to see PSAs with builders, more infrastructure in the ground, or is it just really having everything teed up and ready to go in terms of entitlement? I'm sure that varies from market to market, but just curious the importance or not of PSAs with builders.
I think in terms of, and this is probably more of an outside California thing, Chris, because Chris, in California, you work with a lot of developer builders that are probably not only doing horizontal, but vertical, but outside, where like in Texas and some of the, I'll call it Southeast markets, where you have that bifurcation of developer and builder. To answer your question, Carter, yeah, the answer is kind of yes to all of the above. Again, further along, as well as deposits that are up and often released as part of the capital stack that would go in and gives that capital groups a lot more certainty that those groups are going to be there and work through and have, I'll call it, skin in the game up front prior to them funding any dollars. I think that's accurate.
Yeah, and I echo that in California. If you're doing a master plan A&D deal, having a builder in tow with hard money deposits, I think is really important. We've gotten into because there's just so much costs in the land and development in California. There's been very creative structures with builder partners on how deposits are released. And, traditionally there's been a 19% deposit cap, but there's a bunch of new structures, whether it's OBS, land banking, and just deposit structures and releasing additional deposits against installation of infrastructure. Mm-hmm. Helped unlock land projects. Frankly, it's a tough area to develop lots. Like you said, Mike, there's a lot of builders that are developing their own lots, but in the cases where there are true master plans, it's difficult. And we've had a lot of creative solutions. And I think we're going to get to this later, but including working with Carter and his team on bond financing.
Yeah. And to that point, thanks, Chris. What we're seeing too is that the bond buyers are wanting to see a lot of more skin in the game, and they want to see contracts, not just LOIs, but actual sales to builders with hard money. and or the builders having taken fee title. And with that having been said, there still is plenty of market in the public debt markets, although it's becoming more discerning in where it goes. And let me just piggyback on that. How does the existence of a special district impact the credit decision of capital? Mike, let me throw it over to you first, and then Chris, I'm going to bring it back to you in California.
Yeah, you bet, Carter. I think it's interesting enough, and I think Chris will have a different answer in some regards here. Outside of California, as it relates to the special district, and without sounding disparaging for I'll call it folks outside of California, I think there's some, I'll call it learning curve and sophistication level that we deal with outside of California in different markets, that just having those developers or folks kind of understand those mechanisms. And it's not even really the operators, it's often the banks or capital participants in those deals. So I think we need to have a sophisticated capital group that's involved to really help that out. I think the exceptions are MUDs, for example, in Houston. You really can't do a deal in Houston without a MUD, for example. So I think that is an easier understanding and sell to a bank or an equity group. But I think, Carter, you've probably experienced this with PIDs in Texas. It's relatively newer phenomenon. And so we're seeing it really kind of across the board, and there's a lot of education process there. So I think to answer the question, it does impact the decision of capital to some extent. And I think it's an ongoing learning process due to the, I don't want to call it lack of sophistication, but lack of the presence of the newness of it in many regards.
Thanks. Chris, how about California?
Well, the obvious component is there's a big effect of the profitability of the deal based on the CFDs, which is the primary tool in California. Many times the majority of the profit is the CFD in a deal with just a little profit from the developed lots. But the bigger theme, and Carter, I've worked with you on multiple deals now where we have $100 million plus development stack to solve, and builder deposits can be part of that equation. But proving out the value in the land and setting up these transactions in a way where the bond market can see true value in the land, and clear execution from very strong builders that are committed to the project has allowed us to bring some of these financing tools into the capital stack and actually be a source for the project. So it's very, very complicated. In California, we do have, I think, very sophisticated developers and capital groups. But this is kind of the top of it all, combining those 3 or 4 different sources to make a project work. So I think it's as important as ever. I think right now, obviously, we're going through. It's been a little bit turbulent, and it's been a little challenging. But I think that's turning around very quickly, and I think those markets are getting stronger every day. And I think we're back at it.
Yeah. And Chris, it's been great working with you and your team, because it really is. Especially, it's always a jigsaw puzzle to put the capital stack together, but in California, it's even more complicated, and bigger costs and capital stacks are required. So and as we begin, to spend more and more time in California, it would really be nice if we could accelerate some of the CFD bond proceeds into the capital stack sooner rather than later to actually offset some of these costs. We're able to do that a lot more freely in Texas and in other states than we are in California. But I think it would really benefit the state and the development community in general if we were able to get back to the way to some degree, we were financing infrastructure in the 80s when the CFD law was passed in California. I digress. Let me get back to each of you with a question related to what are the most attractive offerings that each of you are seeing in your respective marketplace, and what are the typical terms of this type of financing? And feel free to talk about debt equity, lot banking, or whatever you're seeing is most interesting, as well as the timing required to take this from start of the financing process to the closing of the financing process. Mike, do you want to go first?
Yeah, that was a lot to unpack. I'll try to hit it.
Sorry.
I want here, Carter.
I can repeat the question.
Yeah, loaded question for sure. So I'll try to tackle it and answer it the best way I can. I think, and I caught the back end of that. So timing wise, again, like I mentioned earlier, I think in the go-go times, it was hey, you got to be nimble and respond quick and do as much diligence as you can. I think, thankfully, to be candid, I think those days are behind us. I think everyone, and not that people were not being prudent necessarily, but when you have to work at that breakneck, pace, things get missed. And I think now we're back to a more normalized scenario where folks are able to respond and respond in, I'll call it, no less than 30 days, but probably no more than 90 days. And I think that sweet spot is probably that 45 to 60 day window of what we think is working expeditiously towards a closing from, I'll call it a term letter or whatever, LOI, whatever you want to talk, whatever nomenclature you want to use. And so, we see if we have that cadence, we're getting deals done. I think that the types of deals that we're seeing or what's resonating, without getting too specific, and this does really speak to land lot banking as well as, I'll call it dequity solutions, I'll call it high leverage debt as it relates to land development. And again, in all the markets that we work on, it really boils down to, I'll call it one term, which is structured finance. We are not doing as many, I'll call it real true joint venture type structures. I think for the ease of not just documentation, but just for the ease of you do your part, I'll do my part, and being very spelled out, we're seeing a lot more transactions under that structured finance option, whether that's lot banking, again, whether that's high leverage debt, just for expediency, probably more than anything. But it's interesting because I grew up in the business for 20 years on the equity side where everything was a venture and you had venture documents and you had a partner. I think folks still look at this as having a capital partner, but it's not a true partnership. And so I think that's the trend that we've seen over the last several years. And it allows builders and developers and operators to, you're in my business, but not completely in my business, and kind of I'll keep you at a distance. And as long as from the capital provider standpoint, they get a structure and a deal where they sleep a little bit easier at night. And if the operator doesn't execute, i.e. take down the lots and or work within that loan term, they have rights and remedies and can respond accordingly, whether they own it or they had to foreclose on it. I think it just makes it an easier disposition one way or the other. So we're seeing continued activity there, and that's only accelerated over the last couple of years, and certainly over the most recent history. So I think I answered parts of your question, but
that was great.
I don't want to drone on. I'll let Chris chime in where I missed.
In California, we just have a very small amount of private builders, and a lot of these private builders have established relationships. A lot of these builders are getting to the point where they're internally capitalized. A lot of these builders are, and Mike, it's interesting that the public builders have used land banking. And I think even the private builders outside of California have used land banking.
Right.
In California, the private builders have not used land banking that much. And I'm in the middle of talking to a number of private builders right now about how that could work, how that can help them manage their balance sheet, how that could potentially replace a joint venture equity partner. And so that is so I'm not seeing a bunch of JV equity on the home building side, but I am helping with debt, regional banks, finding the right lender that can acknowledge entitlement land lift, that can fund A&D, and then talking about the bridge lending side, the land banking side. And then I will say the bridge market is very active. There's a bunch of new players. There's a lot of people that need to close deals, kick the can down the road. Maybe they can't get equity. And the bridge market, we've been doing a number of deals in that space. But really, Carter, you asked the question, the most attractive asset. And I think it's in California, it's land. And that can be in a number of different ways, whether it's developing or entitling.
Yeah. And Chris, you brought up public versus privates. And we know there's a huge dichotomy in relation to, what the publics can borrow at, how they can access money versus the privates. Any comments, observations related to how the privates are funding land acquisition, development, and vertical construction? And I mean, you touched on a little bit, Chris, with some of these structures that they may want to look at. But since you brought it up, I just wanted to see if we could drill down a little further.
Well, I think the privates are entitling their own land quite a bit. Mm-hmm. So they're able to get time under an option to purchase, and they take that time and get the project fully entitled, maybe even permit ready. And there might be a bridge loan solution to get it to permit ready. And then it's really just, land is so expensive in California that the most of the home building community can get very attractive bank financing, regional bank financing at 80% loan to cost or higher on a revolver on a multi-phase project. Mm-hmm. And so that's generally the pathway that I'm seeing most of the privates execute on.
Mike, anything to add?
Yeah, I think again, outside of California, and I'll call it the far more land affordable markets as well, Georgia, Carolinas, Texas to some extent, we are seeing, as I mentioned, kind of this structured finance scenario where you get a higher leverage debt provider that comes in with 80% of the stack, call it 75 to 80% of the capital stack, and then the remainder 20 to 25 is made up of deposits from home builders, merchant home builders, and equity. So we're seeing that as a pretty viable solution from a developer standpoint. From the home builder standpoint, to Chris's, I think Chris touched on it. We do see a fair amount of privately held home builders utilize lot bank financing. And, while they're not judged on Wall Street, of course, because they're not there, they treat it in a very similar fashion in terms of return on assets. So they do value that, I'll call it, having an asset-light balance sheet. While they're not public, they still have lines of credit with large banks. And so they are scrutinized one way or the other. So it is resonating and being utilized by privately held firms as well. And I think part of it's that, but the other part of it is, again, as I mentioned before, just it's kind of the easy button. I know what I need to do. The document tells me I need to take down X number of lots for X price. And if I don't, I know what happens. And whereas in a venture, you have so much more nuance, you have a lot of uncertainty, and there's a lot of, you have a true partner. And so I think part of it is a lot of these builders across the country have now, they've made more money than they ever had over the last several years. And they have the ability to, I'll call it, chart their own path a little bit, and don't have the ability to put in a larger equity slug than they've ever had the ability to do. And rather than put that in as true joint venture equity, why not advance that in a high debt leverage position or lot bank where you can, it's truly, your project, it's under your control. You could do what you want, build what you want, as long as you perform and take down the lots and do what you're supposed to do. You can, again, control your own destiny.
Yeah. And is there any changes that either of you have seen recently in relation to what the capital providers are doing to protect their position that may be different than previously? Any changes in that realm, guys?
I'll jump in really quick. I think they're doing the same stuff, Carter. I think, like Mike said, they're just demanding more time, and they have the leverage to ask for more time. And even the builder community or the buyer community has the ability to ask for more time from sellers. So I do think there's just deeper diligence going on and more timely diligence, to Mike's comments earlier.
Okay.
Yeah. And to add to that, I think I'll boil it down. In my mind, I'd liken it. The analogy I'd give you is chiseling, and so there's chiseling going on where it's a little bit lower advance rate, it's a little bit higher of a rate, it's a little bit more deposit, whatever it might be. I think there's, I don't want to call it death by a thousand paper cuts, but it's a little bit of that. So you're, whatever they can do to, I'll call it all the little things that add up at the end of the day. If they can get it and they like the deal and are looking to move forward, they're going to try to get that.
Yeah, makes sense. And both of you, it's my understanding, have funds that you operate in your individual niches where you can provide capital to qualified borrowers. Would either of you like to comment more on each of your funds and what their preferred investment strategy is? Mike, you want to go first?
Yeah, I'll jump in first. Yeah. To your point, Carter, we do have kind of a, I'll call it a bespoke fund that we don't, other than this right here, we don't really advertise in a major way, but we do reserve that for, I'll call it select clients of high net worth, and where we manage money on behalf of high net worth individuals. And we are focused on anything residential for sale that, again, that is, and I'll keep it very generic, but anything that is opportunistic and unique. We like to play in a space that is well below the radar of any institutional providers that we work with, which are numerous in size and scale, and really write these, I'll call it below the radar equity checks of $3 to $5 million on average, and kind of serve what we believe to be, I'll call it the missing middle, for lack of a better term, above where country club money might play, with doctors and lawyers throwing money in a pot, and certainly well below where any institutional group would play, because the dollars are just not large enough. So we're, again, very opportunistic and just very, very operator focused, Carter. Really looking what we think is important right now in light of where we are. Operation is everything. So we're really keenly focused on pairing and partnering with the right operators.
Yeah. Thanks, Mike. Chris, how about you?
Yeah, we created an asset management platform to help certain investors that don't have as much experience, the team, the desire to stay, day to day or month to month or week to week with projects and their development partners. So on our team, we do have a former regional president of a home builder. We have a professional with 20 plus years of experience inside of home builders that is on the finance side and reporting side. We have accounting teams that help review invoices and track financials and budgets and reprojections. So we do that on behalf of certain clients that need that help, and generally it's in a smaller check size range, much like Mike was talking about. And so we found that to be just kind of another way to serve our clients and help get deals done.
Yeah, that's a real important service for sure. Guys, is there any questions that I should have asked but didn't, that you feel would be important for our listeners to understand as it relates to the current state of capital around the country? Mike, do you want to go first, and then we'll go to Chris?
Yeah, you bet. I think really what we're seeing, it's not really more of an observation where we see the opportunity. And I think a lot of capital groups see that as well, are in, I'll call it relative affordability submarkets. And we're seeing a lot of activity in the Carolinas, in Georgia, certainly Texas, of course, where I'm headquartered here. And we think that's where we see a lot of capital groups gravitating towards. And without sounding cliche, I do think it's a function of maybe the new reality that we find ourselves in, where the suburbs have really taken off over the last few years here in light of COVID and the post effects of that. I don't think those are going away anytime soon. I do think, work from home and or hybrid type of scenarios will be in play for a long time, if not for ever. And so I still think that I think there's a lot of demand that is pushing further out into those markets. So I think that's, observation that I would make is that, doesn't mean that that's the only place we're focusing, but that's where we're seeing quite a bit of activity and trying to make hay.
Yep. Thanks, Mike. Chris, any closing comments?
I just think the problems and solutions are changing rapidly. Our affiliation with Land Advisors lets us really have boots on the ground experience, and we're seeing the problems pop up and how they're handled. I'm talking to Mike and his team. Our team's talking to his team, trying to figure out solutions. We're talking to you, Carter, at launch. We're talking to our market consultant, Clarity. We're talking to our consulting development group, Qtative, because there's just a bunch of problems that are changing and solutions. And it's a full-time job to stay current with how to solve those, and really the new capital groups that are helping solve those, and the new financial products that are solving those. So, I just encourage people to reach out, and if they've got a project, I assume Mike would say the same thing. Let us look at it, and I think we can always add a little value by, not always, but a lot of times we're going to be able to look at it a little bit differently, and it might be something that adds a ton of value to your company and your project.
Yeah, no, Chris, and that's a real important point. And really our discussion of the land to lots concept, especially as it relates to Land Advisors organization, the umbrella for which we're all under. But with one phone call, you get the brokerage, you get debt, you get equity, you get lot banking, you get special districts, you get project management, you get market related consulting, all with one call. And we're able to bring all of those professionals on a call to help our landowners, developers, home builders move projects forward. So thanks for bringing that up, Chris. Really appreciate it. And Chris, if any of our listeners want to get in touch with you, how's the best way to for them to contact you?
Our website is lakebridgecap.com. All our V cards are on there for our team, and that's a good way to get in touch with us, or reach out to you, Carter.
Okay, thanks. Mike?
Yep, same here, landadvisorscapital.com, and all of our contact information, our team, all 7 members as well, available there, and feel free to reach out to anyone and everyone. We'll pick up the phone.
Great. Chris, Mike, I really appreciate you taking the time to participate in today's podcast. I'll make sure that all of your contact information is included in our show notes. And I would like to thank everyone for listening. And if you found this podcast interesting, I really encourage you to share it with your teams and subscribe to Land to Lots wherever you access your podcast. Thank you, everyone.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcast to never miss a new episode.